Dear viewers, welcome to yet another episode of Expert Speaks. We had the union budget recently, which created a lot of commotion because of the tax proposals that were brought in. There was a lot of backlash, and the issue has been debated in both houses of parliament. And now the Finance Act 2024 is enacted. Now we know exactly what is there in the Act and what is that the general public and the NRIs and the resident have to follow as a part of this Act. To brief you on various aspects of this Act, particularly with reference to sale of properties, I am talking to the expert of the week, Chartered Accountant CA Sriram Rao, in this episode. Stay till the end of the video. There are many finer points which are very, very important. This is NRI Money Clinic for you, and I am Dr. Chandrakant, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to brief you on Finance Act 2024 and its implications for NRIs, who can be better than my popular faculty member, Chartered Accountant Sriram Rao. Sriram Rao is very popular on our channel. He has simplified several of the tax proposals which are applicable to NRIs. He has appeared on multiple episodes and he is a practitioner of direct taxes, partner at Nitin J. Shetty & Co. He has helped countless NRIs in solving their tax relief. Welcome again, Mr. Sriram Rao.
Thank you.
Mr. Sriram Rao, there was so much of a commotion post the presentation of the budget, particularly with respect to long-term capital gains tax, removal of indexation from the computation of capital gains when it comes to question of property sale. Now that the Finance Act 2024 is here, how does it differ from the proposal it was made when it was presented? What changes have come in?
This Finance Act 2024 has made several tweaks as far as declaration of capital gain income from sale of immovable property is concerned. And today I'm going to explain specifically how a sale of immovable property by a non-resident with that immovable property held in India post 23rd day of July 2024. If at all a sale that has happened post 23rd of July 2024, which has held by that particular non-resident for a period of more than 24 months, that is a long-term capital asset. So in that respect, I'm going to give a couple of pointers where one has to be very careful about and do the tax calculation accordingly. Majorly, there has been two amendments which has been brought in this respect. One, the rate of tax on long-term capital gains from sale of an immovable property has been reduced to 12.5% from 20%, which is a very welcome. However, whenever we say, there is no gain without any pain. So like that, the indexation benefit which was available, that is to say, increasing the cost of acquisition or cost of improvement from the base year till the year of sale, the indexation benefit was available so that to match that cost because of the inflation increase from year on year. That indexation benefit has been done away with. That means no more indexation benefit. It has been by the finance ministry or the finance minister rather. She has explained that it is for simplification of taxation on sale of long-term assets. She has done this way so that there are only very easy method for calculation. Sale consideration minus the cost of acquisition. Whatever remains is the capital gain. On that, pay 12.5% rate of tax. So on one hand, she has reduced the rate of tax and another hand, she has reduced the indexation bill. This is the two major changes that has happened in this Finance Act 2024 as far as sale of immovable property by a non-resident is concerned.
I am given to understand, post this backlash, she made certain changes with respect to resident Indians while computing the capital gains tax. However, she has left NRIs out of this reckoning. I do not understand the logic behind leaving out the NRI. I just do not understand. It's my personal opinion. I could be wrong. Government could be right. She may have a valid reasons to leave the NRIs. But prima facie, when I look at it, I feel NRI community has been discriminated. What do you feel about this? Why NRI community has been left behind? Do you know any answers in this?
Frankly speaking, I do not have any answers in this regard. I am only a practitioner in income tax. Whatever is the law, that I can interpret and provide you the needed information how one needs to comply with the provisions of the Income Tax Act. However, this is for the finance ministry and the finance minister themselves. They have to come out with an explanation. Of course, whatever the mechanism of taxation, what I've said till now, it was applicable to the residents as well. However, that is only when the finance bill was announced. But when that finance act has been enacted, after passing it through the Rajya Sabha as well as the presidential assent, there has been an amendment wherein the residents have been given, I can say a little bit of margin by way of reducing the tax liability on this kind of capital gain. If at all, such capital gain taxes at 12.5% without indexation on sale of immovable properties are more than the earlier regime of taxation in respect of capital gain taxation with indexation benefit at the rate of 20. Meaning thereby, whichever is less, you pay the tax. Like that, one arrangement has been done for the resident. However, that arrangement has not been given, or that provision has not been given for the non-resident. Frankly speaking, I do not have any answer why this discrimination has been done. Of course, from a chartered accountant fraternity as well as other practitioners fraternity, we have always gone ahead and given a representation so that for everybody, the indexation benefit has to be brought in, especially in respect of sale of immovable property. However, when it got passed in Rajya Sabha as well as it got presidential assent, the entire modification what we have proposed has not been taken into consideration. Only that consideration has been taken in respect of residents only, but not in respect of non-resident. Non-resident has been given flat rate of 12.5% without indexation. This is how they have structured it.
See, it's a welcome move if you want to simplify the tax structure. But non-resident individuals should not be read as non-required Indians. That's the only thing. A community which pours in $120 billion into India, sweats it out outside of India for no apparent reason being left out. It may not make a difference, but the perception that is given is that discrimination has been. I request the concerned forums to represent this to the finance ministry. It's a genuine requirement. There's no need to be discriminating about this community. And we should take it up, as simple as that. Nevertheless, anyway, now the act is in place. Let's look at its implication. Now, how does it really impact the tax outgo from an individual perspective? Have you done any calculation? Can you give me a few calculations to explain how does it materially impact someone?
See, one can say under certain fact and circumstances, this amendment will be beneficial. With the 12.5% rate of tax, the tax actually which has to be paid by a person will be lesser than the tax otherwise it would have been payable if at all the tax was paid at 20% with indexation. I'll give about 5 examples wherein the property was purchased, say for example for an amount of rupees 10 lakhs on a particular day, and it has been sold on or after 23rd of July 2024 and during this financial year 24-20. So in this respect, what could be the break-even point as such, because of which the new regime will be more beneficial. That the new regime means 12.5% rate of tax will be more beneficial and the old will not be so much beneficial. For example, if the property was purchased for 10 lakhs, date of purchase on or prior to 1/4/2001, say sale consideration is around 80 lakhs. Whenever now a person is selling, it is about 80 lakh rupees. So under earlier regime, if one has to make the tax calculation, the index value of the base year is 100, whereas indexed value of this financial year is 363. So approximately 3.63 times the base cost of 10 lakhs will get increased. That means from a sale consideration of about 80 lakhs, indexed cost, if you deduct 36 lakh 30,000, you will end up having a capital gain of 43 lakh 83,000. And on that, at the rate of 20%, tax will be about 8 lakh 76,000. Similarly, if you calculate the same values in the new regime, say for about 80 lakh rupees of sale consideration, deduct 10 lakhs without indexation, the cost of acquisition, the earlier cost of acquisition of 2001, 10 lakh rupees. 70 lakh will be the actual capital gain. On that capital gain at 12.5% rate of tax, the tax liability will be approximately 8,76,000. It means if the sale consideration, if you are able to extract more than 80 lakh for that particular property, then the more the profit, the better the beneficial provision of the new tax regime would be. That means to say, if the sale consideration is 90 lakh, then your tax liability under without indexation 12.5% rate of tax will be lesser than the tax which you have to actually pay at 20% with indexation. This is how one needs to see. This is, if I have to say, there is a gap of say 24 years from the date of purchase. It's very old. But what about, we'll take one more example. Let the property purchase value would be 10 lakh rupees, but date of purchase is say 1/4/2006. That is within financial year 6-7 that property was purchased. Now, the sale consideration one was able to extract is about 62,60,000 approximately. Let us stay at that value. Indexed value for this year is 363. And indexed value for the base year, that is 6-7. This year, I purchased the property on 6-7 is 122. So, at this juncture, there will be a break-even. At old value, old way of calculation of taxes with the indexation, the final tax liability will be 6,58,000. And same tax liability will be, be made by the person, would be incurred by the person under the new tax regime at 12.5% without indexation. That means if one is able to extract about 5.25 times of the base cost of whatever you purchase at that value, then you will end up having benefit of the new tax regime at 12.5% rate of tax without indexation. Otherwise, old tax regime would have been beneficial. So these two examples, we can, further change that example. Say, for example, say in 2012, you purchase the property. At that time, if you have just 2.17 times the increase in the value, that means approximately from 10 lakh rupees, the value has gone up to say 31 lakh rupees. So about 21 lakhs is the net profit. So about 3.17 times of the value of the actual purchase cost, or say 217% profit, absolute profit, if you are able to extract. Then more than that profit what you extract, the better would be for you, because you will be coming within the new tax regime, which will be beneficial for you at 12.5% rate of tax. So same way, if it is say purchased in 2017, about 5 or 6 years back. So at that time, if you are able to extract absolute profit of 90% of the value or more than that, then obviously the new tax regime would be beneficial for you. Wherein, your tax liability will be break even at about 89 to 90% of the absolute profit margin. At the same time, if you purchase the property just 2 years back, so you will have to extract the absolute profit in excess of about 26%. Only then the new tax regime would be beneficial. That is at 12.5% rate of tax would be beneficial for you. Otherwise, the old tax regime would be beneficial for you. So it is very subjective. See, this is only 5 examples I could give, but there can be numerous examples. And when the year passes by, the examples can differ a lot. So it is very subjective to say which tax regime would have been beneficial. But nevertheless, for the non-resident, as on date, the applicable rate is only new tax regime. Think from the point of view of the fact that, from this year onwards, you pay very simply sale consideration minus the cost of acquisition. What is the capital gain on that 12.5% rate of tax? This is how it has to be. Now, I would like to give one caveat here. I have not included the surcharge and cess, which is primarily determinative of the taxable total income of the person. The surcharge and cess can vary. It can be 0% or 10% or 15% based on the total income of the person. That's why I have not included the surcharge while calculating this tax liability.
So prima facie, it appears that somebody who sells the property at a higher level, higher the price, probably the new tax structure is beneficial to. There is a case in point where you can ask your chartered accountant or a commercial accountant to compute your capital gains as per the old regime as well as the new. If you are a resident individual, you can choose whatever that suits you. If you are an NRI, feel happy if you are getting a higher price, you are on the better side of taxation, you are paying lesser. Or wait for a better price to come in. So you'll get a better price and you pay lesser taxes. That's the way we have to look at it. And that's how it looks like. So every dark cloud also has a silver lining.
Again, for the residents, the benefit of the indexation, whichever is lower, that is available only for those properties which were purchased 23rd on or before 23rd of July 2024. That means if a non-resident or a resident, whoever it may be, he purchases the property now, he will never get a benefit of 20%. So from here onwards, whoever is purchasing property in India, they are fine because they are, kept at the same wavelength. But only those who have already purchased the property and they are resident at the time of sale, only they will be benefited.
Few questions that are there in mind. I do not know the fine print of Finance Act 2020. The devil is always in the detail. One doubt that is there in the mind of NRI community is, I am a resident Indian when I bought the property. When I am selling, I am a non-resident. Or I am a non-resident at the time of buying the property, but a resident while selling the property. or it could be both. I am a resident when I bought it, but I am a non-resident when I'm selling it. Any of these combinations have anything to do with the type of taxation or the amount of taxation that needs to be paid?
Tax calculation mechanism as far as capital gain is concerned is actually very simple. One need to see, because capital gain arises only when there is an actual transfer of the property. So only when there is an actual transfer, one need to see what is the residential status of that particular person for that particular year. On the date of transfer, if a person is a non-resident, then the 12.5% rate of tax without indexation will be the manner in which he has to pay the tax on the capital gain. It's very simple. It has to do nothing with at the time of purchase of the property, whether he was a resident, non-resident, etc. At the time of sale, one has to be see what is his residential status. If he is a resident, then calculation will be different. If he is a non-resident, then it is very simple. Sale minus cost into 12.5%. That will be the way in which the capital gain tax has to be calculated.
There can be other issues involved here. See, for example, people acquire properties by way of inheritance. There are parents who give properties to the children. Now, I do not know how the law affects this. Is there, for computation of capital gains, what is the holding period? When will the capital gains be considered as long-term or short-term? Are there any guiding principle? Are there any deviations when it comes to question of holding period in such circumstances?
See, if a property is acquired by way of gift or say inheritance or say from somebody else, so at that time, then the holding period in which you have held the property plus the holding period which the erstwhile predecessor has held the property, both have to be combined, because at the time of transfer by way of a gift or by way of inheritance, there is actually no transfer of property from the perspective of income tax. So what they are saying is the earlier period also has to be added for calculation of holding period for you while calculating your tax liability. This was the mechanism earlier also. This mechanism is continuing further also. So for calculation of 24 months period, so you have held only for 6 months after you inherited the property by way of a gift or say from your inheritance from by way of a will or something like that. But prior to you holding that for 6 months, the other person has already held it for say more than 24 months or say 18 months. So both put together 18 plus 6 more than 24 months. That means it becomes a long-term capital asset taxable as a long-term capital gain. That's how it has to be.
One more issue is there are countless cases where the properties were purchased long back.
Correct.
We don't even know what is the purchase cost at that point of time. I will say 1960, 1947, whatever it could be. So there could be umpteen number of possibilities which exist. How will I take the purchase cost for these very old properties? Are there any guidelines? Are there any cutoff dates? Are there any circle rates? How does system identify the purchase cost for these kind of properties?
See, in the earlier regime, wherein there was indexation benefit, etc. The cutoff date from where the value has to be adopted was 1/4/2001. That continues now also, meaning thereby, if the property is purchased on or prior to 1/4/2001, then the government value or guidance value, circle rate or stamp duty value, whatever you may call it as in your particular, that value as on 1/4/2001 needs to be adopted as cost of acquisition. So this is very simple. This is how now also or in future also one needs to arrive at while calculating the cost of acquisition if the property was purchased on or prior to 1/4/2001. It continues. There is no amendment.
The sale consideration of any property is a price agreed between the buyer and the seller. Now this can give rise to lots of wrongdoings on the part of buyers or seller to reduce the taxation component of it. To avoid that, government had last time told them there will be a circle rate, a guidance rate for each of the territories when you do a transactions, and it had given a tolerance limit of 10% or something like that. Now with this new rule, how does these rates work out? Are there any amendments towards that, or the same systems will continue?
The same system will continue now also. There is no amendment in this regard. That means to say the sale consideration is rupees 10 lakh rupees. So the government value of that is say 11 lakh rupees. That is 10% in excess of your sale consideration. So if this is the situation, then no issues. The sale consideration will remain at 10 lakh rupees for calculation of capital gain. However, if the government value is exceeding rupees 11 lakh, say 11 lakh 1 rupee, then instead of taking into consideration the 10 lakh rupee sale consideration which you have actually received, you have to take 11 lakh 1 rupee as your sale consideration. From that, you have to deduct the cost of acquisition while arriving at your capital gain. This is how it has to be done. This was the mechanism post budget also. This mechanism continues. There is no amendment in this.
One specific case of NRIs is, in case of NRIs, they come back and they have an RNOR status before they are full-fledged resident status.
Correct.
How does the law apply in case of RNOR status for returning NRIs?
RNOR status, I have explained this earlier also. The explanation itself, RNOR, that means resident but not ordinarily resident. That means it's a subcategory of a resident itself. So, if a person is categorized as RNOR for a particular financial year, at that point of time, he will be considered as resident while arriving at the capital gain taxes. That means he will get the benefit of index value of capital gain with the 20% rate of tax, or without indexation at 12.5% rate of tax, whichever is lower if the property was purchased prior to 23rd July of 2024. So this mechanism is available for him if he becomes a RNOR, because RNOR is just a subcategory of resident. They are not actually aligned with the non-resident.
In the earlier regime, to save on the capital gains tax payable under specific sections of income tax, certain relief was available, 54EC bonds, reinvestment into another property, and these kind of exemptions were given, or a facility was given to save on the taxes. Now, because of this Finance Act 2020, has any of these things changed?
No, there is no amendment in this regard. The person who is, availing the benefit of 54AC by investing bonds or in another residential house, etc., they can still invest and avail the benefit if the sale of property is having a long-term capital gain. So for long-term capital gain, this benefit can still be applicable. 54EC, the level also remains the same. Maximum of 50 lakh deduction per financial year would be provided by investing in some specified bonds. And for residential house, prescribed rules and regulations of Section 54 or 54F, as the case may be, will be applicable. There is no amendment in this.
Prior to this enactment of Finance Act 2024, the TDS rates applicable to NRIs with respect to sale of properties was pretty steep. Now, what has changed when it comes to question of TDS for NRIs when they sell the properties?
See, now when a non-resident sells the property, the rate of tax has been reduced to 12.5%. That means this is what the maximum amount of tax one has to pay. So similarly, the TDS rate also has been reduced from 20% to 12.5%. So, if a non-resident is a seller now, then the buyer is obligated to deduct the TDS on immovable property which is sold on or after 23rd of July at the rate of 12.5% plus surcharge plus cess as applicable. Meaning thereby, if the sale consideration is between 0 to 50 lakh rupees, then no surcharges will be applicable, and the effective rate of TDS including the cess will be 13%, 1-3. If the sale consideration is between 50 lakh rupees to 100 lakh rupees, that is 1 crore, then surcharge for this slab rate will be 10%. So the effective rate of tax will be 14.3%. And if the consideration is above 1 crore, that is above 100 lakh, then surcharge will be at 15%. That means the effective rate of tax will be 14.95%. Earlier it was 20, or it might go up to 24%, 23.92%. But now with the reduction in the rate of taxes, the final TDS also has been reduced to the same line.
So the TDS is applied on the total sale consideration, whereas actually the tax that has to be paid by the seller is on the capital gains that he has made. That means government is collecting more TDS. Seller is supposed to pay with the cess. Probably this difference will cover that particular thing. So NRIs can pay 12.5% and be done with it. That's one way of looking at it. Earlier, there was a provision that I don't want to pay anything extra TDS and I can apply to department for a lower TDS certificate. Now, this issue has become redundant, or is there still a scope that somebody can apply for lower TDS certificate and his burden of TDS can come down?
Yes, definitely. There could be possibilities where one may apply for lower TDS certificate and get the benefit out of it for reduction in the rate of TDS as well. Because we never know that, say for example, the property is purchased, say 2 years back, say for about 1 crore rupees. Then it is being sold now, say for example, for 1 crore 30. So the rate of TDS otherwise will be about 14.95%, about 15% on the 1 crore 30 lakh rupees. Instead, you can apply so that the 14.95% rate of tax can be applied only on the 30 lakh, that is between on the actual capital gain. And in this regard, we will have to provide certain necessary documents, etc., along with an application, and apply for lower tax deduction certificate. If it is beneficial, one can opt for. If it is not beneficial, then they can go for filing the return of income, which is mandatory if at all, whether one has to apply for lower tax deduction certificate or not, because TDS is not a primary liability. It is only indicative that the TDS has been deducted. It is onus on the SSE to file the tax return and adjust the TDS, and then if at all the TDS is in excess of actual tax liability to be paid, that can be claimed as a refund. This is how the procedure goes.
So an NRI can decide at the time of selling the property, ask your chartered accountant, ask them to compute the tax that you are supposed to pay. If there is a huge difference between the actual tax that is required to be paid versus the TDS obligation that gets created, probably there is a case for you to apply for a lower TDS certificate, be done with it, get the clearance and pay the required amount of taxes, and you don't have to bother. But if it is coming to somewhere around what the TDS is getting deducted, you can decide based on the merit of the case.
True.
That's how it looks like. Anyway, Ram Rao, thank you very much for your time. Within such a short span of time, I know the Finance Act has just come in and you are really, really kind enough to go through it in detail, and for the benefit of my audience have come out with all these clarifications. I remain in gratitude to you for your kindness, for your time, and always the willing nature of you to come on our channel and give this benefit to the audience. I remain in gratitude to you. Thank you very much.
You're welcome.
Dear viewers, hope the video that I have done today helped you to understand what has changed when it comes to question of taxation when you sell the properties, particularly from the angle of NRIs. If it helped you to understand all the finer points of these tax changes, please do give me a thumbs up. Do not forget to share these videos with your near and dear ones, friends and relatives, and all the social media and WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another useful topic with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.